Okay, Chapter 4, 4.1, Preparing Financial Information for a Departmentalized Business. We have 4 objectives. You need to be able to identify the steps necessary to prepare for end-of-period financial reporting. You need to be able to prepare an unadjusted trial balance. You need to be able to journalize adjusting entries, and you need to be able to prepare an adjusted trial balance. So we know what a fiscal period is, the length of time for which a business summarizes its financial information and reports its financial performance. A fiscal year, then, we should know this too, is a fiscal period consisting of 12 consecutive months. Schedule of accounts receivable. We've created one of these before. This is a listing of all of our customer accounts, the account balances, and then the total amount due from all customers, which is their account balances, or which is the total of all of their account balances. Schedule of accounts payable is just as very similar to the accounts receivable. Schedule of accounts receivable. It's a listing of all of our vendor accounts, their account balances, and then the total amount due all vendors, to all vendors, sorry. Some businesses call this listing an accounts payable trial balance. Adjusting entries, those are journal entries recorded to update general ledger accounts at the end of the fiscal period. An unadjusted trial balance is a trial balance that is prepared before adjusting entries are posted. So this is an example of an unadjusted trial balance. It is proof of the equality of debits and credits in a general ledger. That's what we call a trial balance. Okay, so the unadjusted one is before adjusting entries are posted. Okay, so first we're looking at our uncollectible accounts adjustment. The adjustment information is for December 31st. It says estimate of uncollectible accounts is $2,210.61. So here is the allowance for uncollectible, that estimate of uncollectible accounts. It says the current balance is the allowance for uncollectible is $95.69. An adjusting entry for $2,114.92 is required to increase the allowance account balance to $2,210. So what we're saying here is the allowance for uncollectible was $95.69, but we need it to be this $2,210.61. So to do that, we need to credit the allowance for uncollectible, the difference amount, so $2,114.92, and then we'll debit the uncollectible accounts expense. Okay, so here what it looks like in our journal under our adjusting entries. Okay, next we have our merchandise inventory adjustment. Adjustment information again is for December 31st. And it gives us merchandise inventory grills is $89,349.72, and then ending merchandise inventory for furniture is $102,915.36. So to bring the grills inventory up to date, the balance of merchandise inventory grills needs to be increased by $3,201.04. Similarly, the $3,816.53 credit adjusting entry reduces the balance of merchandise inventory. So the reason that these don't look the same is because one is increasing merchandise inventory and one is reducing merchandise inventory. So this adjustment is going to depend on if we are increasing or reducing that merchandise inventory. Okay? Okay, next adjustment is for our supplies. So it says to bring supplies account up to date, the balance must be decreased by $5,180.87. We see that our balance before was $7,610.87, and we're estimating that the amount of supplies on hand are $2,430. So we're going to find the difference between those two numbers. That tells us that we're going to credit supplies for this $5,180.87, and then we would debit our supplies expense. This is the amount of supplies that we are estimating that we use then during the fiscal period. Next one is for our insurance, so we're going to do the same thing. Our insurance balance was $14,000. We are estimating that we have $2,000 left, so we're going to find the difference between that. That will be our $12,000. So we'll debit insurance expense for $12,000, or we'll credit prepaid insurance for $12,000. Okay, plant assets are physical assets that will be used for a number of years in the operation of a business. So something that we're going to hold on to for longer than a year. Depreciation expense, the portion of a plant asset's cost that is transferred to an expense account in each fiscal period during the asset's full life. The amount of depreciation is just an estimate. So what I like to give as an example is if we think of a car, if we buy a car in 2018 and we own it for 3 years and try to sell it, that car is not going to be worth the same amount as when we bought it in 2018. It will depreciate in value. So our depreciation expense adjustment, we have depreciation for office equipment and for store equipment. So what we're going to do again is we're going to find that difference. Here they're showing us the depreciation for office equipment, and here they're showing us the depreciation for store equipment. So we'll debit the expense account, and then we'll credit the accumulated depreciation, so how much it depreciates each year. Preparing an adjusted trial balance then is once we have done our adjusting entries and those are posted, then we'll prepare an adjusted trial balance to make sure that our debits equal credits. Calculating the federal income tax adjustment. Different tax rates are applied to different levels of net income. A tax bracket is each tax rate and taxable income amount on one line of a tax table. Marginal tax rate is the tax rate associated with a tax bracket. The amount of federal income tax a corporation must pay is going to be calculated using a tax rate table issued by the IRS. So this would be issued by the IRS for us. It says that this example shows us how to calculate tax for an income of $82,565.81. So what we do is we see that taxable income is more than $75,000, but it's less than $100,000. Okay, so it's showing us here is our tax, $13,750 plus 34% of the amount that's over $75,000. So what they did here is they took that income, $82,565.81, minus that $75,000. So here, minus that 75. So we see the income subject to the marginal tax is $7,565.81. Now that tax rate we said was 34%. So we're going to use that number we just figured out times 34% to get $2,572.38. We're then going to take that amount plus that base that we already have here, $13,750, to figure out our total federal income tax is $16,322.38. So corporations are required to make quarterly federal income tax payments. So the adjusting entry increases our federal income tax expense and increases the balance of federal income tax payable by $2,322.38 to the actual amount of the $16,000. So what we're seeing here is that quarterly amount that we are paying for a corporation. When we add up all of those, we see that we need to make an adjustment of the 2,322.38 to make it equal that 16,000 that we owe. Okay, so we're going to debit federal income tax expense and we'll credit the payable account. So the completed trial balance provides the information necessary to prepare the financials. So once we do this adjusted trial balance, the last number that we'd put in is this federal income tax expense and the federal income tax payable. Then we're going to total and prove to make sure that debits equal credits. A worksheet is a columnar accounting form used to summarize the general ledger information needed to prepare financial statements. Prior to computerized accounting systems, the worksheet was the most effective tool for collecting the information needed to prepare the financial statements. All right, audit your understanding. Question number 1. What 2 reports are prepared to prove the accuracy of posting to subsidiary ledgers? That would be our schedule of accounts receivable and our schedule of accounts payable. Number 2, why are adjustments made to certain accounts at the end of the fiscal period? This allows us to bring certain general ledger accounts up to date. And then last question, number 3, explain how income before income taxes is calculated using an adjusted trial balance. So we would subtract the total of the income statement accounts having a debit balance, exempt for federal income tax expense, from the total of the income statement accounts having a credit balance. Include any debit or credit balances of income summary accounts. Okay, that was the end of the lecture for 4.1. Go ahead and go to the work together 4.1.